Silver just hit $67 per ounce. All-time highs, up 90% in 6 months, up 500% since 2020. Everyone's asking the same question. Is this the start of a move to $200 plus, or are we at a dangerous top about to crash? Today I'm going to show you both scenarios. Not the one you want to hear, both. Because one of the most respected analysts in precious metals is calling for 200 plus silver by mid-2026. But the charts from the past 50 years are screaming that a 40 to 70% crash could come first. Which is right. I'm going to give you the bullish case with all the evidence. Then I'm going to give you the bearish case with historical precedent. Then I'm going to tell you exactly what I'm doing with my silver position. By the end of this video, you'll have a clear strategy regardless of which scenario plays out. Because here's the truth. You need to be prepared for both. Let's analyze what's really happening with silver. Let me start with the bullish case because it's compelling. Here's why respected analysts are calling for 200 plus silver. Reason 1. Michael Oliver's 200 prediction. Michael Oliver, one of the most respected technical analysts in precious metals, just went on record predicting $200 silver by Q2 2026. This matters because Michael Oliver has been bearish on precious metals multiple times in the past when the charts called for it. He's not a permabull, he's analytical. His track record is strong. He bases predictions on momentum structure analysis, not hype. His reasoning, silver is breaking out of a 50-year trading range. This is historically unprecedented. When copper broke out of a 30-year range, it quadrupled. When lead broke out in 2007, it quadrupled. Silver is breaking a 50-year range. The potential velocity is immense. Reason 2, Samsung solid-state batteries. This is the bombshell nobody's talking about enough. Eric Sprott, the king of silver, just revealed Samsung's new solid-state batteries use 1 kilogram of silver per battery. That's over 32 ounces of silver per electric vehicle. If these batteries capture just 20% of the EV market, they would consume the entire year's global silver production. Think about that. One use case, one technology, 20% market share, consumes 100% of annual mine supply. And that's before solar panels, 5G infrastructure, AI data centers, medical devices, traditional electronics. Reason 3, supply deficit is real. The fundamentals are staggering. Structural supply deficit for years. Mining production cannot keep up with demand. Silver is primarily a byproduct metal. Supply is price inelastic. China implementing export controls starting January 2026. London and COMEX inventories at multi-year lows. Industrial demand is non-optional. Silver gets used regardless of price. Reason 4, market cap analysis. Silver just became the 4th largest asset in the world at $4 trillion. Market cap. It's closing in on NVIDIA. When silver overtakes NVIDIA and Apple, it will get mainstream media attention. The masses will wake up. The other 95% of people who don't own silver will start buying. That flood of retail money on top of existing industrial demand? Explosive. Reason 5. Gold to silver ratio currently trading around 63 to 1 gold to silver. During the 1980 Hunt Brothers peak, it hit 17 to 1. If we replicate that ratio, current gold price, $2,700. Divide by 17 equals $158 silver. If gold hits $3,400, many predict this. Divide by 17 equals $200 silver. Reason 6. Historical precedent from Hunt Brothers Era A. In 1979 to 1980, gold did 4 times in 1 year. Silver did 10 times in 1 year. We've only done about 2 times this cycle. If we replicate even half of that velocity, current $67 times 5 equals 335 silver. Reason 7. Asian demand tsunami. China, accumulating, implementing export controls. India, record imports, 1.4 billion people. South Korea, Samsung investing $7 billion into Mexican silver mine. These countries are positioning for a supply shortage. They know something. The bullish thesis summary. Breaking 50-year technical pattern, industrial use case that consumes entire supply batteries, actual physical supply deficit, mainstream attention coming, historical precedent for 10 times moves, multiple sovereign nations accumulating. All of this points to significantly higher prices. $100 plus seems probable. $150 to $200 seems possible. Some are even calling for $300 to $500. Now here's where it gets uncomfortable. The bearish case is equally compelling. It's 10 o'clock to 18:15. The bearish case. Why a crash to 40 to 50 is likely first. Let me show you what the charts from the past 50 years are screaming. This is uncomfortable but necessary. The quarterly bar analysis. Silver's current quarterly performance is the third largest in 50-plus years of history. Only 2 quarters were larger. Q4 1979, up 69%. Q3 2010, up 42%. Here's what happened next in both cases, 1979 to 1980. Precedent, Q3 1979, up 92%. Q4 1979, up 69%, peak euphoria. Q1 1980, down 49%, catastrophic crash. Over next 4 years, down 70% total from peak 2010 to 2011. Precedent, Q4 2010, up 42%. Q1 2011, up 22%, continued higher briefly. Q2 2011, up 32%, final blow off top to $49. Q3 2011, down 8%, then crashed 70% over next 4 years, 2011 to 2015. Current situation. We just did a 140% annual gain, Q4 2024. This is the third largest quarterly bar in 50 years. History shows, after extreme quarterly bars, the next quarter is typically a reversal bar. Both prior instances led to 40 to 70% crashes within months to years. The volatility reality. Silver has a pattern of severe drawdowns. 2008, 60% crash. 2011, 38% crash. 2013, 35% crash. Multiple 27 to 38% pullbacks throughout bull markets. These aren't anomalies. This is silver's nature. If you can't handle 40 to 50% drawdowns, you shouldn't be in silver. The different this time trap. Here's where it gets psychological. At every prior top, the fundamentals look perfect. At the 1980 top, supply deficit, industrial demand, monetary crisis, geopolitical tension. At the 2011 top, supply deficit, industrial demand, QE infinity, debt crisis. Sound familiar? Those are the exact arguments being made today. The fundamentals are always perfect at the top. That's how tops form. Everyone is convinced This time is different because of current fundamental reason, but charts don't care about fundamentals short term. The market cap problem. Silver is now $4 trillion market cap. In 1980, when it made those massive quarterly bars, it was under $500 billion market cap. It's 8 times larger now. To move a $4 trillion asset requires exponentially more capital than moving a $500 billion asset. The larger the market cap, the harder it is to maintain parabolic moves. The annual bar warning. Silver's up $40 per ounce this year alone. That's the entire move from 1991 to 2011, 20 years, compressed into 1 year. This is the largest annual dollar gain in history. Even in 1979, the biggest percentage year at 361%, the dollar gain was less than this year. When annual bars get this extended, next year often goes higher. See 1979 to 1980, 2010 to 2011. But they often correct significantly first. The year after the peak, brutal reversals. The sentiment extreme. Everyone is bullish. Every YouTube video is 200 silver, 500 silver. Silver to the moon. When I made videos about silver at 30 to 36 6 months ago, nobody cared. Now at $67, everyone cares. That's a sentiment extreme. Historically, when everyone is bullish, we're near a top. The probability assessment, based on 50 years of history. After a quarterly bar, this extreme, third largest ever, there's an 80 to 90% probability of at least a consolidation or pullback in the next 3 to 6 months. After an annual bar this extreme, there's a 70% probability of a 20 to 40% correction within 12 months. These aren't guarantees, but they're probabilities based on historical pattern recognition. The bearish thesis summary. Third largest quarterly bar in 50 years. Both prior instances crashed 40 to 70%. Sentiment at extreme bullish levels. Everyone is all in. Annual bar most extended in dollar terms in history. Every fundamental reason was present at prior tops too. Volatility pattern suggests 40% plus crashes are normal for silver. Market cap is 8 times larger than 1980. Harder to move. All of this points to a high probability consolidation or crash before higher prices. 18 and 15 to 23.30. The smart strategy. How to play both scenarios. Here's where most people get this wrong. They pick a side and go all in. That's gambling, not investing. Let me show you the smart strategy that works regardless of which scenario plays out. Strategy 1. If you bought under $30 to $35, early buyers, you're up 90 to 120%. Congratulations. Here's what to do. Take 30 to 50% profits now. Not because silver's done, because risk management. If silver crashes 50% to $33, you'll have locked in massive gains on half your position. If silver goes to $200, you still have 50 to 70% riding for the big move. This is not weak hands. This is intelligent position management. You've already won. Now protect the win while keeping upside exposure. Strategy 2. If you haven't bought yet, new buyers, do not chase at $67 because of FOMO. Wait for a pullback. Set buy orders at 48 to 52 range, 30% pullback. 55 to 58 range, 15 to 20% pullback. 60 to 62 range, 10% pullback based on historical patterns. Q1 2026 will likely provide a better entry. After extreme Q4 bars, Q1 often consolidates or corrects. Be patient. If silver goes to $80 without you, so be it. Better to miss a move than to buy the top and suffer a 50% drawdown. Strategy 3. Position sizing is everything. Never have more than 10 to 15% of your net worth in any single commodity. Silver is volatile. A 50% crash would wipe out 5 to 7.5% of your total net worth. If you're at 10 to 15% allocation, painful but survivable. If you're 50% allocated to silver and it crashes 50%, you just lost 25% of your net worth. Catastrophic. Strategy 4. The both can be right scenario. Here's what I think is most likely. Q1 2026, silver corrects to $45 to $55, 30 to 35% pullback. Q2 to Q3 2026, silver consolidates, builds base. Q4 2026 to 2027, silver resumes uptrend toward 100 to 150. 2027 to 2028, potential blow off top to 150 to 250. Both the bears and bulls could be right. Bears right about short-term correction. Bulls right about long-term $200 plus target. Trade the time frames separately. Strategy 5. Set stop losses. If you can't handle volatility, if you cannot psychologically handle seeing your position drop 40%, set a stop loss at $50, 25% below current. You'll get stopped out if the crash happens. You'll preserve capital for re-entry lower. Yes, you might get stopped out and silver goes to $200 without you. But that's better than panic selling at $35 during a 50% crash. Strategy 6. The time horizon matters short term, 3 to 6 months. Bearish, correction likely. Medium term, 6 to 18 months. Neutral, consolidation. Long term, 2 to 5 years. Bullish, 100 to 200 plus possible. Don't confuse time frames. I can be bearish short term and bullish long term simultaneously. They're not contradictory. Strategy 7. Have a plan for each scenario. Scenario A. Silver crashes to $45. My action? Buy aggressively. Accumulate 10% allocation. Scenario B. Silver consolidates $60 to $70 for 6 months. My action? Buy smaller amounts monthly. Build position slowly. Scenario C. Silver breaks out above $75 and maintains it. My action? Admit I was wrong on timing. Buy a smaller position. Accept missed optimal entry. Having a plan for each scenario removes emotion. 2330 to 2500. What I'm actually doing, full transparency. Here's exactly what I'm doing with my own money. My current position, I bought silver at 28 to 32 earlier this year. I've taken 40x amount for the 48 to 52 range. My reasoning, I believe both scenarios have merit. Short-term correction is probable based on historical patterns. Long-term move to $100 to $200 is possible based on fundamentals. I'm managing risk by taking some profits while maintaining majority exposure. What I'll do in each scenario. If silver crashes to $48, I'll deploy all my cash, bringing my total allocation to 12 to 15%. I'll hold that position for 2 to 5 years, targeting $150 to $200. If silver goes to $85 without correcting, I'll admit my timing was wrong. I'll keep my remaining 60% position. I'll avoid FOMO buying at higher levels. My long-term view, 5 to 10 years from now, silver will likely be significantly higher than $67. Whether it's $120, $180, or $250, I don't know. But the fundamentals, industrial demand, supply deficit, Asian accumulation, support much higher prices long term. The question is, do we get there in a straight line or do we crash first? History suggests we crash first. I'm positioned for that, but I'm also positioned in case I'm wrong. The final word. You don't have to pick one scenario and bet your entire net worth on it. You can believe both. Silver could crash 40% in the next 6 months. Silver could hit $200 plus in the next 2 to 3 years. Manage your position accordingly. Take some profits if you're up big. Wait for pullbacks if you're not in yet. Keep position sizes reasonable, 10 to 15% max. Have a plan for each scenario. The worst thing you can do is buy at $67 with your entire net worth, because silver to $500, or sell everything at $67 because it's going to crash. Either extreme will likely cost you. Play it smart. Prepare for both. That's how you win regardless of what happens. Now you have both sides. Make your decision, but make it with your eyes open. Good luck.